what happens on COMEX is a pretty good mirror for what's going on in London. So overall, I think what we're seeing is the potential for another liquidity squeeze. The level of open interest is a very, very good indicator of the level of speculative interest in a contract. And with it at the lowest it's been for nearly 20 years, that really tells us that no one, I mean, okay, there are some long positions, obviously, because you've got 125,000 contracts out there. And I think the thing that's fascinating is that they will have spoken. I mean, some of the big banks who have been talking about gold going to, say, $6,000 by the end of 2026, or, they come out with these forecasts, all of them higher than this.
The global monetary landscape continues to evolve as governments face mounting debt burdens, persistent inflationary pressures, and growing concerns about the long-term stability of fiat currencies. Investors are increasingly paying attention to assets that preserve purchasing power and protect against financial uncertainty. Alasdair Macleod is a respected monetary analyst known for his deep understanding of currency systems, central banking, and precious metals. His research frequently focuses on the relationships among government debt, monetary policy, and the role of gold in the global financial system. One of the primary themes discussed is the growing strain on the existing debt-based monetary framework. Governments around the world continue accumulating liabilities at a pace that many believe cannot be sustained indefinitely. At the same time, central banks face the difficult challenge of controlling inflation without causing significant economic damage. These pressures have renewed interest in gold as a monetary asset rather than simply a commodity. Central bank purchases remain strong, and investors are increasingly viewing precious metals as a hedge against currency depreciation and financial instability. Predictions suggest that if debt levels continue rising and monetary expansion remains necessary to support economic growth, gold could attract substantially more capital in the years ahead. While short-term corrections should be expected, the broader trend remains supportive as confidence in traditional financial systems faces increasing pressure. Now, we present the clips from his interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Paper markets sort of being used to manipulate prices and so on and so forth. I think it's probably, the word I would use is the paper markets have dominated silver pricing. I mean, I understand market making and I understand what is involved. But rather than go into that, I'll try and answer your question about open interest. In the old days, say, before 2025, when you had speculative interest and all the rest of it, and you had good turnover, you would have speculators who would go in, they would buy contracts, they would put in a stop loss, whatever. The swaps, who are basically the market makers and bullion bank trading desks, would know pretty well where these stops are. And if they saw a slowing down in the momentum of speculative buying, then it would be in their interest to push the price down and trigger those stops. And it was a very, very profitable business. I mean, the trading side of it is immensely profitable. And so long as the price was subdued below that $50 level, if you like, the end of the month valuation of those short positions was sort of, you could bear it, given that you were making an awful lot of money on the trading side. That's now no longer the case. We're looking at prices well over $50 an ounce. And consequently, the swaps, again, market makers, bullion bank trading desks, are in the hole for an average of well over $3 billion each, if you look at the numbers that come out from the CFTC. So this is a very uncomfortable position, particularly if, as a bullion bank, you have the intelligence about what's really going on in the silver market, how it's being drained out of the West and going into the East, how you see China has now become a substantial net importer, as you were saying earlier, Michelle, hitting record quantities, in some months, then you are frightened. You don't like this. So what you will do is you will, if someone wants to come in and buy a number of contracts off you, you will make a pretty wide price. You will say, well, if you want to sell taking contemporary prices, if we say something like you can sell to me at 74, but you can only buy at 77, whoa, I don't know that I want to do that. So you can see that what they're doing is they're chickening out of the the futures market. Now, what happens on COMEX is a pretty good mirror for what's going on in London. So overall, I think what we're seeing is the potential for another liquidity squeeze. The level of open interest is a very, very good indicator of the level of speculative interest in a contract. And with it at the lowest it's been for nearly 20 years, that really tells us that no one, I mean, okay, there are some long positions, obviously, because you've got 125,000 contracts out there. But the idea that you've got punters in there saying I'm going to buy this and hopefully I'll spin a bit of money overnight or over the day. I want to be out on a day trader sort of thing. That's gone. That's not there. So we just don't have that liquidity. And I think it's quite clearly an indication that this contract is actually failing. And the other thing that's interesting, I know we'll probably come on to gold a little later, but we've got exactly the same thing in gold now. I mean, the level of open interest in gold has just collapsed to, again, levels we haven't seen for almost 20 years. I think basically what's happened is that the swaps, the market makers and bullion trading desks have basically taken fright of the situation. They know that they mustn't be short, and they're desperately trying to close their position. Now, normally what happens is that they will be short on COMEX, but long in London, and that way they have a balanced book. I don't think necessarily that the experience in London last October, when the lease rate went up to 40%, really means that is a valid strategy. Bearing in mind that if you look at the amount of silver in London, the vast majority of that is actually ETFs, ETPs, like SLV and so on and so forth. And also, there are other holders of silver who are not speculators at all. They're just holding on to it long term. As well as that, I guess that storing silver in one of these proper vaults is a sensible thing for an industrial user of silver to do. So the amount of actual liquidity in London, I think, is very, very low. And it wouldn't take very, very much to tip the scales and, if you like, trigger a real bear squeeze. And that, I think, explains the fear that the swaps on COMEX really have. They know that London, you can't really be long in London, and therefore you've got no way of covering your shorts on COMEX. And we haven't seen the premiums and lease rates jump on gold or anything like that. But again, the liquidity in gold seems to have died down quite a bit. Again, you have to ask yourself, why is it that the market makers, the bullion banks and so on, don't want to be short? And I think the thing that's fascinating is that they will have spoken. I mean, some of the big banks who have been talking about gold going to, say, $6,000 by the end of 2026, or, they come out with these forecasts, all of them higher than this. I think what's happened is that they have spoken off the record at very senior levels to the central banks in Asia, perhaps, who have been acquiring gold, and maybe also those that have a silver interest. So you could see, that's not so much, the silver is not so much central banks, that's more industrial. You can see that they will have discovered a situation where, for goodness sake, don't be short. And this is why I think that they have discouraged speculation on COMEX in particular. And this is where we're seeing it. And I think to a lesser extent, probably also in London.
Another important point is the growing disconnect between financial markets and underlying economic realities. Asset prices have benefited from years of monetary support, low interest rates, and expanding liquidity, but these policies have also contributed to rising debt and declining purchasing power. As inflation remains a concern, investors are reassessing traditional approaches to wealth preservation. The discussion highlights how gold and silver continue to serve as alternatives to fiat currencies during periods of monetary uncertainty. Physical demand remains an important factor, particularly as investors seek assets that are not dependent on the promises of governments or financial institutions. Predictions indicate that continued fiscal deficits, monetary accommodation, and geopolitical uncertainty could strengthen demand for precious metals throughout the coming years, even if markets experience periods of volatility along the way. Let's get back to the interview.
I'm not going to talk about anybody's individual position, but the one thing we do know is that very senior bankers talk to central banks at the highest level. And, this would be, if you like, on a no names, no pack drill type basis. And the thing that's fascinating, Michelle, particularly in the case of gold, is how you've got major American banks coming out with forecasts for the gold price going higher. And at the same time, their managed money, their investment side, as it were, with discretionary portfolios, high net worth individuals, sort of minimum like $50 million sort of thing. These banks have got portfolios amounting to trillions of dollars. And have they put them into gold or silver? No. I mean, the level of if you like, ETF interest, if you can separate it out, and the World Gold Council does a brilliant job on this following ETFs. When you look at the amount of gold, ETF gold, held in North American portfolios estimated to be worth something like $160 trillion all told. The amount of gold on the ETFs means that their exposure through ETFs is roughly 0.2%. That is not exposure. It really isn't. They haven't got it. And yet, on the banking side, you've got people like, sort of senior executives on the banking side saying, gold is going higher. Why haven't their investment management departments gone out and bought it? Part of it, I think, is cultural, actually. I mean, the other thing is that these guys, they don't understand gold. Gold itself is not a regulated investment. ETFs are. It's a way around that regulatory hurdle. And also they don't like mining. I mean, mining's a dirty business and all the rest of it. We'd far rather have something like Nvidia, which we know is running, than try and understand mine. I mean, last time we invested in mines was probably 30 years ago, and the guys who knew what they were doing in our department have retired. So you can see that there's real lethargy, I think, when it comes to understanding gold, silver, and also, if you like, the mines that are involved. It hasn't translated into actual allocation changes. I think part of this is that there is a tendency in very large banks to set up their own means, if you like, of exposure to this sort of thing. They just haven't done it. So it's not something that has sort of really filtered through into the portfolios, not in any meaningful way anyway. And as to your point about the recommendations going through from senior bank analysts and all the rest of it, I mean, there was some pick up, if you like, in the level of ETFs outstanding in North American hands, but, not really that much. Yeah, I believe it is. I mean, I'll just give you one aspect of this. India has been opening coal-driven power stations in enormous numbers. I mean, 60 or so of these things being opened and so on. And so there is a big carbon footprint. And so President Modi decides to offset this by encouraging the major Indian conglomerates like Reliance Industries to invest in photovoltaic cell production. And indeed they have. What they've done is they've rushed out and they've spent, billions of dollars equivalent on manufacturing facilities and producing their own enormous solar farm and all the rest of it. Now, the problem is, where do they get the silver from? I mean, if they go along to the refiners say back at the queue. And I think that quite a lot of the standing for delivery that we're seeing is really rather desperate attempts by Indians and other national, businesses, if you like, around Asia, trying to sort of get involved in this market. And in the case of India, of course, there are government subsidies being offered for conglomerates going into this business. So that's an example, I think, of the sort of thing that's happening. Now, their demand for silver is going to continue apace. And the other thing is that one of the big sources of demand, of course, growing demand, has been electric vehicles. And now that Hormuz is closed, guess what? Tesla's sales are going through the roof. People are literally, because of the fear of higher fuel prices and all the rest of it, it's actually been a boost to EV sales. EVs need silver. And you also mentioned, the missile situation. Certainly my very good information in the UK is that we've just about run out of ordnance. And that is, because basically it's all being consumed over Ukraine. And now, of course, we've also got the Israeli situation. So America's got very little ordnance. NATO as a whole has got very little. We're all very, very short of ordnance. And I guess Israel is as well. So that it means that an awful lot of missile technology has got to be replaced at an accelerating rate. It's hardly surprising that America puts silver on the critical minerals list. Where is it going to get its silver from? So you've got that. And another thing, I think, is that these AI data centers, they consume huge amounts of silver. A really big data center will take 1/3 of a ton of silver in terms of computer power and all the rest of it and all the cabling and all that sort of stuff. 1/3 of a ton of silver in one of these things. And we're all wanting to build these data centers. It is quite remarkable how we've got these demand factors hitting silver. I really do think that it should be priced as an industrial metal. It's markets that, through habit, I think, are pricing silver purely as a monetary metal. But the monetary demand is not all that great. I know there has been an accumulation of investment, if you like. If you look at ETFs, I think there's something like 1 billion ounces or 1.3 billion ounces in global ETFs, silver ETFs. And but that's not growing much actually from that level. And interestingly, with all the hiatus of a price going up to $120 and then falling down to $61 and then bouncing back up to 75, the decline in that ETF, the total ETF total, is actually very, very minimal. It's extraordinary. This should be priced as an industrial metal. That is where the demand is at the moment. Now, that's not to say that the monetary aspect will come back in the future. I fully expect it to do so. I think when it does, it will be because gold is going better and people begin to think silver is a cheap way into gold. To buy something at $90 or $80 or whatever is a far more attractive proposition to the masses than, let's say, paying $5,000, if you see what I mean. So, and not only that, but, the relationship very much has been that if gold goes up 1%, silver goes up 2%. So, this is a sort of the ultimate speculative play, if you like, with respect to gold. So that is yet to come in. And unfortunately, I think it's likely to clash with all the sort of environmental and other demands for silver. And also the fact that China is no longer supplying the rest of the world with her surplus.
The longer-term outlook centers on the belief that the global financial system may be approaching a significant transition. Throughout history, excessive debt accumulation has often resulted in monetary adjustments, currency reforms, or shifts in the structure of international finance. Current conditions exhibit many of the same characteristics that have preceded past major economic turning points. Gold remains central to this analysis because it functions as a monetary asset with no counterparty risk. Unlike fiat currencies, its value is not dependent on government policy or central bank decisions. As confidence in debt-based systems faces increasing challenges, demand for gold could continue expanding among central banks, institutional investors, and private individuals. Silver may also benefit from this environment due to its historical monetary role and growing industrial demand. Predictions based on these trends suggest that precious metals could appreciate substantially over the remainder of the decade. Expanding government debt, persistent fiscal deficits, inflationary pressures, and geopolitical tensions all contribute to a constructive long-term outlook, while markets are likely to experience sharp corrections and temporary setbacks. The broader trend appears increasingly favorable. The key message is that investors should focus on structural economic forces rather than short-term market noise. If confidence in fiat currencies continues to weaken and monetary instability becomes more pronounced, gold and silver could assume a far more significant role within the global financial system than they currently occupy. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.